This video is going to be an introduction for stocks. So in chapter 2, we talk about the primary market and the secondary market for the stocks. The primary market is a market for the sale of new securities by corporations. So the company issue new stocks. It can either be the initial public offering, the IPO, or SEO, the seasonal equity offering. So the company issue new stocks and the investors purchase those new stocks. The money they spend to purchase those new issued stocks are the funding for the company. And then the issued stocks will be traded against the investors, and that's the secondary market. And there are more than one types of stocks. There is common stock and there is preferred stock. So the common stock is the ownership shares in publicly held corporation. So owning the common stock means you are owning a share of the company, and different from the bonds. So for the bonds, there is a guaranteed fixed coupon, and you are guaranteed to get the face value in the end of maturity. So you are guaranteed to get some kinds of yield or return. But for the stock, there is no guarantee of return. The stock price can go up or go down. Any loss or any gain is not guaranteed. And if the bond is not able to pay the coupon they promise, they have legal obligations for it. But for stocks, if you are facing some loss because the stock price go down, there's no legal obligation for the corporation. Okay? So there is a risk to hold the stock. There is a risk that you are likely to lose money if the company is not doing well. And there are common stock and there are also preferred stock. So the preferred stock is different from the common stock in a few ways. First, the preferred stock has no voting rights. Second, the preferred stock usually guarantees a fixed dividend in perpetuity. And the third, the preferred stock may have a callable function. So a dividend is a periodic cash distribution from the firm to the shareholders. When the company have extra cash, they can choose either to retain the money for future investment, or they can just distribute those cash to the investors, and then it's called a dividend. The preferred stock usually guarantees a fixed dividend, and this fixed dividend, okay, it's a promise comes with the preferred stock. However, if the company is not doing well, they can delay this dividend distribution. So the company says we are short of cash for the moment, and we will just delay the payment of this dividend. However, for preferred stocks, they are still going to get paid once the company is out of trouble. Once the company have the liquidity to pay the dividends, they need to make up those delayed dividends. But for common stockholders, if the company is doing well, the company can say, okay, we are going to distribute dividends to all our shareholders, but there's no guarantees of any fixed dividends. And the preferred stock may have a callable function, means the company, the corporation can call back their preferred stock, okay, just repurchase them at a certain price. When we look at a stock, we are also want to say if this stock is overvalued or undervalued, and that's an important thing when we make a decision whether to purchase or to sell the stock. And some ratio we want to look into is the PE ratio, or the price earning ratio, which is the ratio of the stock price divided by the earnings per share. Okay, so next, let's look into. So if you want to look into a stock, say the FedEx, you can search that online in a few websites like MarketWatch or Yahoo Finance. So for example, if you type in one stock, the FedEx, you type the code name FDX here, and what you will see is first, this is the stock price at this time, okay? And it will also tell you the previous close and the open price for today. And then there's bid price and ask price. So the bid price is someone who wants to buy for this stock, they are bidding at this price. Okay, so the bid price here is 159.45, and it says multiplied by 200. It means this price, there are 200 shares bidding at this price, and the ask price is 159.52, which means the sellers are asking to sell at this price, and also there are 200 shares available to sell at this price. So the bid price is always lower than ask price. Why? Because when the bid price is equal or higher than ask price, then the buyers and the sellers can reach an agreement, and that they can just make the transaction happen. So the bid price is always lower and ask price is higher. Then there is no transaction, and you will see those two number of shares that's on the book. Okay, and there is also the first year target estimation, and that's estimated price by those analysts. And there is beta. We'll talk about beta in next chapter. And the beta says it's the correlation between the stock and the market as a whole. Right? And there is day range, 15 to week range, the price range, and there is the trading volume, and it tells you the market capitalization of this company as a whole, and there is the PE ratio, right? The price earning ratio, and there is EPS, which is earning per share. Okay, so the earning per share here is 3.8, and the dividend and the yield. So last time the dividend is $1, and the yield is 0.65%. Okay. So the bid price again is the price at which investors are willing to buy shares, and ask price is the price at which current shareholders are willing to sell their shares. So for example, okay, let's look into some example here. If an investor wished to purchase 100 shares with a bid price of 109.78 and an ask price of 109.99. So how much could the investor expect to pay for the shares? Okay, so here the investor wants to make the purchase. So which price should he look into? The bid price or the ask price? Okay? So the answer here is when you want to purchase something, you are looking for a seller. Okay, and the ask price from the seller is 159.99, and to make the transaction, to make the purchase happen, you need to meet the price. You need to pay the ask price. So that means the price you need to pay is 100 times 159.99. Okay, and that gives $15,999. Okay. Similarly, if you are an investor who wants to sell, and with this bid price in market and ask price in market, what you can get here is to sell for 100 shares. You need to sell them at the bid price available. That means if you want to sell 100 shares, you will get 100 times 109.78. Okay. Next, what's the PE ratio here? So as we said, the PE ratio is the price per share divided by the EPS, earnings per share. Okay? So in the last table, we see the price is 160.39, and the earnings per share is 3.8. Okay? So the PE ratio is 42.25, and that's the number here. And the next, dividend yield. So the dividend yield is the dividends divided by the price. That gives you the dividend yield. So the dividend is $1, okay? And the price is 116.39. So the dividend yield is 0.65%. Okay.